What's going on, everyone? Good evening, good night, good afternoon, good morning if you're watching this somewhere else around the world. It is another day in paradise, and we are here with session 10 of 20. Again, it is Nick here with you, leading today's foray and adventure into candlestick patterns, trend lines, and the averages. Now, that's kind of a general course topic there, obviously, and I could talk probably for 20 hours nonstop about different candlestick patterns and trend lines, averages, different indicators, because look, as technical traders, you're going to find all sorts of stuff out there. You are going to find some weird indicators and things that you'd never even heard of. So trust me when I say that, this is only going to be scratching the surface. I apologize if this is, new for, old for a lot of you, and if this is kind of rehashing beginner content. But, we really want to make sure you understand the fundamentals of technical analysis and the fundamentals of day trading before we get into anything complex, because if you don't really fully understand what a moving average is, how are you supposed to understand what VWAP is, or how you trade moving average crossovers or breakouts or all sorts of different patterns? If you didn't understand what support and resistance were, then you wouldn't understand what half of the other shit I'm going to talk about in other courses would be. So just keep that in mind. Again, this might run a little long. I apologize. I'll try to go through pretty quickly. We just want to give you a baseline understanding for some of this stuff. There's going to be a lot to talk about. And look, we're only going to scratch the surface. But the goal here is for you to walk away, have a good understanding of, all right, so I'm starting to understand what technical analysis is and how to day trade using it. And I'm starting to get a sense for just how crazy some of the stuff out there is in terms of the indicators you can use and the math people have put together and the weird chart setups and all sorts of stuff. So we're going to be covering all sorts of stuff. Again, I apologize if some of this is isn't new for some of you. I'm going to try to give some complex analysis in there as well. I really want you to understand the psychology of a lot of this, because if you can understand what all of this is, then you'll be ready, and then you'll be sure to be able to move on to more complex stuff. If you start trying to use RSI, MACD, stochastics, all of these crazy things that are out there, well, that's great, but you got to make sure you understand the core components first, because everything else is kind of based off of these first couple of lessons here. So let's dive on in. I don't want to waste any more time. This could go a little long. I'm going to try to go pretty quickly here, especially. So as always, we're going to kick off with our habit of the week, as we love to do. This week's habit is relentlessness, being relentless, because if you're going to be a trader, I've talked about this already in our previous course yesterday, you need to be relentless. You need to grind and push and not stop, because it's going to be frustrating. There's going to be dry spells. There's going to be periods where you're sitting there looking and thinking, God damn, this is boring, or holy hell, the market's not doing anything. How am I supposed to make a living watching such a dry market? But believe me, the time will come, and you do not want to be, flat-footed when the trade presents itself or the opportunity arises. And so talking about relentlessness in trading, there's all sorts of different parallels you can take. Jesse Livermore, if you've never read the book Reminiscences of a Stock Operator, it's kind of one of those like classic books that people always say, oh, if you want to know what being a stock trader is like, read that book. It's, a very old book. Jesse Livermore, was a trader a very long time ago, and so some of that may not apply, but the basic core components do. Jesse Livermore built up an absolute fortune trading. He was one of the richest men in the world. He built up the equivalent of billions of dollars trading, and 5 years after that, he was bankrupt. And then after that, he built the fortune back up. He blew out another account. He built another account up. Jesse Livermore built up and blew out accounts like you wouldn't believe in that book and throughout his lifetime. And he was relentless, and it's why we remember him for it and his book. You're going to have blown accounts, or, hopefully you wouldn't have a blown account, but you're going to have blown trades. You're going to have blowouts. You're going to have moments where you're like, what the hell was I thinking? And you need to be relentless. You need to study every aspect of it. When Michael Phelps' team would work with him, and this is true in any kind of performance sport where seconds matter. you better believe they were measuring everything. They were using computers and science like you wouldn't believe. The angle of the dives, his oxygen levels, the swimsuit he used, the goggles he used, is it causing too much drag? If he tilts his hand this way, whatever he does, it's going to be a science boiled down. The ESPN used to have this great, and I don't, they may still do it, this great program where they would break down kind of the angles of football and of sports and the like. And if during this drive Michael Jordan just shifted an extra degree, he would have snapped his leg or something like that. And they love breaking it down like that. But this is the kind of analysis you need to be using to get an edge. You need to be taking every different metric you can, studying the market, studying your own trading metrics. You may be using this trading style or a strategy and being like, man, it's good, but I feel like it could be so much better. And if you spend the time tweaking it and reviewing charts and trying to figure out, well, what is not quite fitting in this trading strategy, it could be some subtle shift that you would have no idea would have such a large impact. And that is why you need to be relentless in your review and in your process to make sure you are mastering and perfecting your craft. There was a good metaphor that I saw with golf where, you're swinging the golf club, and if you were to shift that golf head right before it hits the ball, just, a couple degrees, the ball is suddenly shank central straight into the woods, and you're off hunting with Smokey the Bear looking for your golf ball rather than getting it nice on the green. So, that is perfect metaphor for trading. You need to be relentless in studying your craft and making sure you are perfected. Trading can be a war of attrition. Like I said, this is a marathon, not a sprint. A trader may lose 3 times or more before they get that breakout trade. I believe it was sometime last week, Mike went through a little scenario with you, and he actually did like the math, and he showed you 3 different traders, each of which took the exact same trades with different trading styles and entry and exits and sizing, and those traders had 8 straight losses, 7 straight losses, and you saw loss after loss after loss, but their trading style persisted. And on the 8th and 9th, and I believe the 10th trade, they won, they hit it big, and suddenly they were up 20%, 11%, whatever, depending on their drawdown and their trading system. So you need to be persistent. You may start trading and, there's a law where, you may have just happened to enter trading and enter the market during a bad period for your process or for your trading style. It happens, especially if you take a break or if you're new to the market. You need to be relentless in that pursuit. Failed traders will stop after trying a trade and losing. Trust me, you're going to lose. You're going to lose money in trading. Everyone has losses. Everyone messes up every single day. There may be a day where, you light it up and you don't have a losing trade, but trust me, you're going to look and you might still feel like a loser because you might look at that chart and be like, damn, I only got a point out of this and this stock moved 10 points. What was I thinking? So you need to be relentless in squeezing every bit you can out of the market. Enough about being relentless. I am now going to talk just briefly about technical analysis because, look, we talked about technical analysis yesterday. I told you about the difference between fundamental and technical and how, this technical analysis is really what we're honing in on right now because you can really use this to your advantage to being able to decipher what's going on in the marketplace. And when we're talking about technical analysis, this is where you're going to start to understand that there is a lot of different studies, indicators, chart setups, whatever that you can use at your disposal. Everyone out there who trades technical analysis doesn't use the same indicators. We don't use the same chart setups. And, most people will have multiple things on their charts. And the point there is the more technical indicators that you can get to stack in your favor, the better. You want to have, I see this chart setup which tells me that the stock is probably about to break out. Is it above a certain moving average? What's the RSI look like? Or do I have multiple points? It should be almost a checklist. And you want a certain amount of checks before you're confident that, okay, great, this chart setup worked, but everything else is pointing to the downside. Maybe I should wait. And having a good system like that could save you from taking a trade that you probably shouldn't have taken just because this one setup occurred or this one candlestick pattern emerged. The key here, though, and I'm going to show you in a moment an example of a noisy chart. When I'm showing you indicators and moving averages and all of this other stuff, you need to avoid letting your chart get noisy. Time and time again, I see traders who will have like 50 lines on their chart and like 5 moving averages and RSI and MACD, and I'm like, where the hell are the candlesticks? I can't see them. It looks like, what are those Rorschach paintings? I'm like, am I at a therapist's office? What am I looking at here? And so you need to be careful. Most people have a set number, use 3 indicators or 4 or 2, whatever works with you, but you need to be careful because, putting a whole bunch and cramming a whole bunch of shit on there can also give you paralysis by analysis. Imagine if you had 10 indicators in there, 6 of them are saying yes, up, 4 of them are saying no, 1 of them saying middle. What are you going to do? Who are you going to believe there? So you need to be careful. You also need to avoid, and this is, this is a lot easier said than done, confirmation bias. You see a chart setup and you think, oh, it looks so good to the long side, I think I want to buy, and you see a couple technical indicators and the technical indicators are actually telling you, well, this might be fake because RSI is declining, or something else is crossing over, moving averages are crossed over, and you're like, well, hang on a second. So you start looking for other indicators that confirm your bullish thesis or your bullish bias. You need to have a system, and if you start ignoring that system and looking for indicators and things that only confirm what you want, well, you might be screwing yourself here. You might be looking for things that only confirm what you want. The goal here when we're using technical analysis and when we're using these indicators and these chart patterns that I'm going to be showing you is to understand where the buying and selling is occurring and why. These things aren't there to say, oh, it's above this moving average, it's a buy. This isn't just a simple buy here, sell here because this says this. It's really a, well, the moving averages are crossing. That means the market's accelerating to the upside. Or it means, the buyers have increased in force. And so, this momentum can continue. There are indicators that'll measure, how fast this stock is moving. And so you can literally use it like a miles per hour gauge and understand when the stock is slowing down. It's great. There's so much information you can pull out of the market. The key is pulling out the important information that will help give you an edge in understanding what is happening in that stock you're looking at, what is happening in the market, and then discerning why so that you can better anticipate the future. And remember, it is important to know the full picture. And I underline full picture because we're going to talk about something really, really important and really, really cool, and I think very vital to day trading and really just to trading in general or investing, and that is going to be multiple time frame analysis. But first off, I promised you a noisy chart. I put this together in like 30 seconds. I've seen noisier charts, believe it or not. This is just an example of, I took a simple chart of SPY. I threw some Fibonacci in there, some trend lines. You've got 3 different simple moving averages. You got MACD, RSI, CCI. You got all sorts of stuff. I could have put some volume analysis things on that volume bar. I could have put these little indicators that show up in the chart when a certain chart setup happens, and then to buy. Well, what the hell is this? Can you even tell what the hell the price is in the stock at that point? You've got so many numbers flaring up on your right hand side, you're going to have a seizure. So, this is what I mean by noisy charts, and obviously this is a little bit of an exaggeration, but this is just driving home the point that yes, there is such a thing as too many indicators, and yes, it can absolutely paralyze you. So I talked about multiple time frame analysis. What is that? Because when you're trading, you should say, oh, well, I'm looking at the chart. I'm looking at 5 minutes. I should know what I'm looking at. Yes, but, I'm talking about, knowing the bigger picture, knowing the flow of the current, knowing what's really moving the stock in. Are you buying in a pullback, or, what's the actual timeline you should be looking at? Because every trader out there should be using multiple time frame analysis. Even if you're a scalper, if you're a day trader, a swing trader, a long-term investor, you should be looking at multiple time frame analysis because it could save you. I want you to think of I've got 2 nice little metaphors here for you, and these metaphors are actually incredibly apt for the market. Imagine the market is like the waves of the ocean traveling in all different directions. If you were to look at the ocean, yes, the larger wave is coming towards the shore, but within there you can see, the bottom tide is kind of pulling out into the wave, and you've got little mini waves that are blowing around with the wind, the undertow and the currents pulling you back out to sea. If you were to try to follow a certain wave, but meanwhile you're fighting the current or the riptide, that's going to lead to exhaustion. That wave you're looking at could be brief from the wind. Imagine you're in a raging river and you're trying to swim against a raging river because you see one little wave in front of you and you're like, oh, that must be the direction of the river. I'm going to swim that way. You're going to exhaust yourself. And that is like trying to trade on only one time frame. You're not getting the bigger picture. You're not understanding where the current's moving and where the tide is receding and what the overlying movements are in the stock. And I say that because we all should know, if we've looked at the market on the long term, that yes, the market can go up, but within that are so many different minutiae that you need to know where you are in that period before you take a trade. The time that you look at should fit your strategy. If you're a day trader, if you're a scalper, do you need to give a literal shit what the stock has done 10 years ago? No, unless you're drawing maybe a support and resistance line and you're trying to look for some kind of important inflection point that might come into play today. But you don't need to know that, well, the stock's been decreasing and downtrending for the last 5 years. I mean, yes, but that doesn't mean today it can't go up. And, meanwhile, if you're swing trading and you're a huge long-term investor, do you need to know what this stock is doing minute to minute? Absolutely not. And that's because obviously securities have multiple movements within larger movements. I feel like this is pretty, common understanding. It makes sense. Everyone should know that a stock doesn't go straight up. And so, little stupid example here. Stock A has been steadily going higher for 2 years. Congratulations. It's probably like the market. That stock did not just tick straight up for 2 years. There could have been days, weeks, or months of pullbacks within that uptrend for 2 years. I've got a couple chart examples. And that's because you need to remember the battle between the buyers and sellers is always raging. It may not look like it at times, but trust me, you could look at the hardest up move you've ever seen in the market. I guarantee you there were people shorting in there, because there's always going to be idiots in there shorting or doing something, out the norm. Understanding that blindly buying, you could have hit a 2 month long top where you have a 2 month long pullback, and you could have been stopped out, or you could have been like, damn, I was stupid. If I just realized that I was in the middle of a bull flag or a pullback, I could have gotten such better entries on my long-term investment and exponentially increased my profit. Or shorting a stock just because it was weak today, but if you didn't look at the yearly chart, you didn't notice, oh my God, this thing's on a tear, and this was just a simple day of selling, you could get your ass blown out if you were trying to invest like that. So, little kind of example here, but it's important. I want to hammer that home. And, this is, again, I just pulled up the SPY. This is the simple S&P 500 ETF. This is over 3 years. And yes, the SPY went up throughout those 3 years. And I just highlighted 3 simple areas where you can see and every red dotted line there represents a month. For months at a time, the SPY didn't go anywhere. In fact, some of those months, including the first one, the SPY finished lower than it did, than it started. So, does that mean you should have looked at that and been like, oh, this is it, the SPY's done, SPY's in a down move? No, there are some seriously big red bars on this chart, even before kind of that choppiness, obviously, at the end or the beginning of 2018. But, you need to know the larger picture if you're going to invest. Should you look at a chart like this if you're about to scalp and day trade for seconds at a time? No. So that's kind of where you need to understand your time frames. And so when we're talking about time frame analysis, this is going to be important for technical and fundamental traders, because importantly, it's going to be used to refine your entries. This isn't necessarily there to dissuade you from entering a trade, or telling fundamental traders you need to be looking at charts. But if you can save a fundamental trader from catching a falling knife, why not? A lot of people suggest using 3 time frames when you're analyzing a trade. That does not mean that when you're day trading a stock, you need to have 3 charts of that same stock open. We'll talk about that in a moment. Many people also use 2 time frames. It really depends. And the thesis here, when you're doing multiple time frame analysis, and I'll give you some examples, is you start with the larger time frame and then work your way in. You start with the forest before you get to the trees. That's because you want to understand the larger flow of things, move in a little closer, understand, well, within this larger flow, are we in a little bit of a pullback, a little bit of a correction, a bounce, what have you. And then within there, you want to be refining entries and exits and really kind of catching the minutia of the market. So when we're looking at the multiple time frames, first you want to look at the longer time frame, identify the overall trend, and I'm going to give you some examples in a moment of, well, what time frame should you be looking at. But just remember, the trend is your friend, especially if you're a long-term trader. You don't want to be fighting this long-term trend, so you need to identify where's the current going. Then within there, look at the intermediate time frames. Identify the current short-term trend. Are we in the same direction, or are we in a brief reversal? If we're in a brief reversal, maybe I can wait a moment before I buy this stock or before I invest or whatever it is. Even this can all be applied to day trading as well. Trust me, and we're going to get into that as well. And then you want to look at, all right, we're at this long up move. The river's going that way. We're in a little bit of a pullback, but it looks like we're starting to catch a little bit of a bid here, and I think the intermediate time frame's starting to work in my favor now. All right, now you want to go to the short-term time frame. And this is going to be the noisiest, obviously. There's all sorts of little chops in here, and you want to use that to catch those entries and exits. Really try to refine your entries and exits. And whether you're a technical or fundamental trader, this will help you try to catch, the trend in your favor. Catch those tides in the river or the ocean or whatever. So, that's why, we kind of talk about this. So, what time frames do you use? And I want to just start off right now that this is not a one-size-fits-all. Everyone has their own system. I'm not going to say use this, use this, use this. I'm going to give you some suggestions, but this is suggestions that I've even taken, and I don't use even some of the ones that I'm about to show you because I'm like, well, I like this, but I kind of like this a little better. It kind of fits with my style. You need to make sure it fits you as a trader. And sometimes, you need to fit into a system a little bit yourself, so keep that in mind. But, it also needs to be consistent between trades based on a strategy. If you're just a day trader, you can't be looking at different time frames just because that time frame looks better on this stock than the other time frame. You need to make sure you're being consistent and being fair about it. And it needs to fit you and your trading style. If you hate investing in the long-term buying and selling, and you hate looking at, 3 years down the road, don't look at that chart. It's only going to piss you off. It's only going to upset you and bore you. You may want to pull that up to obviously pull up important support and resistance levels and see important inflection points in that stock, but don't use that to determine your trading entries and exits. Even if you just use 2 time frames, it will be a big help over just one. Trust me, there is a much bigger advantage if you can just even get a general sense of where this stock is going. If you're trading on the 1-minute chart, you should hopefully at least be looking, in the morning when you're doing your prep work at the 30-minute or the hour to make sure that, you understand what this stock is doing. So I'm going to give you some examples here, and this is from a really, really good book. I would recommend everyone trade it or buy it, use it, whatever. It's from a very smart man named Brian Shannon, and it was technical analysis using multiple time frames. And these are some of the time frames that he describes, and if you want to know more about some of these, he describes them in detail in his book. Long-term traders, and we're talking the traders who are investing, buying and holding for weeks at a time or what have you. Their long-term time frame should be a weekly chart where every bar of that candle is a week or a month. And then, that should be going out for years and years, because, you're holding this for a long time. You need to know, is this a good stock? Your intermediate time frame can then go for several months or a year because you want to make sure, well, is this a down year for this stock? Is it choppy? Is the sector getting hit for some reason? Is this presidency been bad for this sector? And then when you're entering, use a daily chart. Use a 30-minute to an hourly chart. You don't need to use a 1-minute chart and watch that frustrating day trading choppiness if you're trying to invest in a stock. You want to hone in, find your entries based on a better time frame. If you're just a swing trader, you're holding for a couple days to a couple weeks, that weekly chart for 1 to 2 years, I'll look at that, set up some levels, understand that, all right, this stock's in a bit of an uptrend here. Use that daily chart for the last couple of months, understand, well, is the stock done nothing? Has it been absolutely dead for the last couple of months? Or have we been in a consolidation and now we're breaking out? And then you want to find, okay, well, now let's take a look at the last couple of days and really hone in and get that entries. Did I get that confirmation that I wanted? And where can I find the support? If you're a short-term trader, you can use the 30-minute chart over maybe a month or two. If you're going to be holding for less than a day, why do you care what this stock has done 2 years ago? Set the support and resistance levels, but past that, it doesn't matter. The momentum of this stock 2 years ago is not going to influence the stock, the momentum on this day alone. The intermediate chart, look at the last 1 or 2 weeks. Is the volume surging into this stock, or a little bit of a pullback? And then obviously you want to only be looking at the last day or two. And then, there is scalper. And, you're in for seconds or minutes at a time. Who cares what the stock's done over the last, past the last couple of days? You're only in the hot stock, the fun stock, the stocks that are moving quick. You're in and out. So it doesn't matter what the stock is doing even just this year or this month. Who cares? Because you're in this stock because right now it's fast, it's moving, it's got the volume, the momentum, and so you're looking at that 1 minute and you're honing in and you're salivating at this stock. I'm going to move on here. Don't worry. You can pause this later, take a screenshot, or to look at this book. I love Brian Shannon's book. I talk about it often. I'm sure Mike has quoted it several times. Now what I want to do, and this may seem a little confusing, and if you don't get it, it's fine. I'm going to show you a stock, and I'm going to show you a stock chart, and it's going to be the exact same stock at the exact same point in time, but looked at from different trading perspectives and different time frames. And you're going to see that that stock is going to tell you several different stories depending on your time frame and depending on what you looked at. So let's say we're looking at the stock and you're a scalper. You're in and out briefly for seconds at a time. First of all, this stock doesn't look that appealing. Let's be honest. It doesn't move. It doesn't do as much volume as you'd like. So you probably wouldn't even be interested in this one. But if you're a scalper, it looks like we're on a bit of a downtrend here. Stock's been kind of making lower lows and can't really pop up at all. So it looks pretty weak. Now, let's say and this is the long-term chart. This is zoning out for a scalper. What if you're a short-term trader? All right. Looks pretty weak. We got a nice little descending tops there. We're sitting at the lows. A short-term trader might be looking at this and saying, all right, this actually might be a nice little breakout on the downside. What about if you're a swing trader? What does your long-term perspective look like? Well, shit, now it actually looks like it might be a long. Now, well, maybe, now it looks like we're still sitting at the highs up there. We're not really rolling over yet. Maybe it'll be enticing on the downside. I'm going to keep an eye on it maybe, but it doesn't look like such a bearish chart all of a sudden. Now, what about a long-term trader? We're zoning out, and this is every bar here is a week. It doesn't really look that weak yet. I mean, it's at the lows of this little consolidation we're in, but we're flagging after an up move. I'm not as interested in the short as that scalper may be. Now let's take a look at the intermediate chart. We're zooming in a little bit. The scalper looking pretty good, man. This might be a good short off of that 27.20 here if we can fail and roll over. Short-term intermediate still looking like a good short. Swing trader. All right, I'm keeping an eye on it. We're still sitting up here. Long-term trader, I'm not going to waste your time on this too much. You're kind of starting to get the picture. Now we're zooming in here. Scalper's looking for that entry. We're looking for that entry on this stock to roll over for the scalper and for the short-term trader. Swing trader zooming in. He's like, all right, well, we're going to have to watch here because if we start making a higher low, this actually might be a good buy for a bull flag breakout. And I'm going to tell you what a bull flag is in a moment if you don't know what that is. And now let's see what these stock did. And it looked pretty bearish and pretty short biased for the scalper and the short-term trader. The other traders, were not quite sure. It looked a little long more. It looked like a flag after a nice up move. And these are the results. That little highlighted section in the middle there, that's the time that we were looking. It was that time where we were kind of bouncing along and sitting down there. And the stock obviously recovered nicely and had a nice move higher. Does that move matter to the scalper? No. He was just trading that day. He was just trading that move. So you got to understand that there's different time frames you need to be looking at depending and different perspectives depending on your trading style. This is a great trade for the swing trader or the investor or something like that. You made 100% on this stock in just 3-4 months. So, if you were looking at the minute chart, it would have scared you away. So it's important to understand, that trading based on your time frame is going to be, and looking at the proper time frames could make or break you, honestly. Let's move on in now, and we're going to talk about some candlestick patterns. And I want you to understand some stuff about this candlestick patterns. This isn't some kind of witchcraft or science. I'm going to be saying some weird words like engulfing pattern and morning star and doji and flag breaks and all of this stuff. it's not like some set rule. It's terms that are coined to kind of describe the price action so that you can better grasp and quickly identify patterns in the market. That's the key here, and that's why we use candlestick patterns, because yes, exactly. It's in the word, candlestick patterns. It's pattern analysis. History rhymes, you want to find repeating patterns and setups. And every single one here isn't going to be a 100% win rate thing. It's just a check in your checkbox. So when we're talking about candlestick patterns, these are setups and recurring patterns in charts that have been given names, and these don't just happen on candlestick charts. You could see them if you use bar charts, and in some of these cases, not all of them, you could see them if you use a line chart maybe. But these, we just use candlestick charts, and largely they were used with candlesticks when a lot of these names were given, so it's just how it is. And look, these are not just arbitrary patterns. No one just saw, oh, it was a small green bar and then a big red bar followed by this, so I'm going to name it this. No, they tell the story and the psychology of the stock in the market. If this pattern happened, it means something. If you saw the stock make a new high and then suddenly fail to get back up there and do something specific on the chart, that pattern's repeated itself. That's telling you the battle between the buyers and the sellers. And these setups can be used for both bullish and bearish setups. There can be reversal patterns, continuation patterns. All of them can tell different stories. And none of these, and I mean none of these, are to be used alone. You should be using these in combination with other indicators and other confirmations. You should be watching price action, watching volume, watching things like that, because yes, this chart may have just put in an engulfing bear pattern that usually says it's going to go down. But, take a look at something else. Make sure your thesis is right. When we're building trading systems, you want multiple ticks in your favor. You want a nice big checklist that you can look at and identify and really give yourself confidence in that trade. We want confident trading, people. We don't want to be doing some shooting at the hip guesswork based on, a handful of indicators. So let's talk about one candlestick, and I'm talking about this one first because I feel it's actually a pretty big one, and it tells a lot, and it's one that you'll see a lot in other patterns as well, and it's called the Doji. And a lot of these actually, I believe, are actually Japanese names, because Japanese candlesticking is a thing, and there's actually a really good book on Japanese candlestick patterns. I don't remember the exact title of it, but I'm sure you'd find it pretty easily. And so what is Dojis? Well, a doji is when the open and the close of a bar, and that bar could be a minute, a day, a week, a 5-minute bar, whatever, are the same price or super, super close. Look, Tesla, $1,000 stock is rarely going to open and close at the exact same price because it has such a wide spread and it's very, very rare. But, it's when that open and close happen at the exact same time. And when you're looking at it at a chart, and we're going to show you chart examples all throughout this presentation, it's going to look like a plus sign. And, a lot of charts will color up bars green and down bars red. Well, if it's a doji, it'll usually be colored white on a chart. And what does that mean? Who cares if the open and the close are at the same price? Well, it signifies indecision in the marketplace. Neither the bulls nor the bears have won out on that candle bar. And that doesn't tell you where it's going to go. Just because they had this little stalemate doesn't say, well, now it's going to reverse or now it's going to go up. Instead, it makes what happens next important. If there is a huge battle that's raging on and then suddenly you see the bulls start taking over, that's a pretty big deal. That means that after that stalemate, the bulls got reinforcements and the bears wore down. And so it can signify a much more important move to follow after that doji. It's an inflection point. It's something important because you see that stalemate that wasn't there before. And it is a bigger deal on larger time frames. Look, the bears winning or a doji happening on a 1-minute chart is important for day traders, obviously, but on a 5-minute or on a 30-minute or an hour, it would be a much bigger deal. And if you're a swing trader, having a doji on a daily bar could be a big deal, or a weekly bar, or a monthly. The larger the time frame, the more significant it is for that stock. Here's another example of what a doji would look like on a stock. You can see it right there, that nice white bar, really long top wick there, and we're going to talk about what those mean because, there are there are different types of dojis. There's a neutral doji. It'll look like a nice little plus sign, and I've got another slide that'll show you some actual pictures of them, what they look like, and that's just even on all sides. The bulls went up a little bit, the bears went down a little bit, no one really went anywhere, and it just kind of closed at even. The long-legged doji looks the same but with very long top and bottom wicks. That means the bulls drove that sucker up, the bears drove that sucker down. It was an absolute bloodbath as people were going everywhere. Body parts were flying, limbs were flying, people were screaming, and in the end, no one won. The gravestone doji, it looks like an upside-down T. And that means that the open and the close were actually the low of the day. That thing opened, it went higher throughout the day, went maybe pretty high, and eventually came back down and closed right where it started. That could be a big deal. That could mean the buyers just exhausted themselves. The buyers took control on the open, spent all their energy driving this thing up, and it ended up closing right where it started. Well, that's exhausting. And the Dragonfly Doji is the opposite. It's going to look like a capital T. And that means the open and the close is the high of the day. It opened up, the bears took control, they drove it down, and lo and behold, the bulls managed to rally back and close it right back up at the top where it started. Just some pictures there just so you can visualize that neutral, that long-legged, that gravestone, that dragonfly. The names are just, clever. You could call them something else if you want. I don't care so long as you know what that signifies. So long as you know that that open and close at the same price is important. It is significant because there was a stalemate here. And understanding that, the gravestone, the bulls, they tried their best. They really tried to drive that stock higher, but they couldn't do it. And the bears took back control, and there was a stalemate, and it closed back where it opened. Let's take a look at some stock charts now, and I'm going to highlight where the doji was, and you'll see, and one of these, a couple of these may have some other factors as well, but the doji was a good sign of a battleground. The first one here is in VSLR. It's a solar company. You saw this stock had a really nice up move here. They actually drove this one up over the last couple of days, and suddenly, bam, it hit a stalemate. You can see the doji. Now, this gap down was presumably due to news, but still, there was a battle before this news even broke. It stalemated. You can see the long wicks even prior as the bulls couldn't maintain their momentum. Let's look at an even better one here. Beyond Meat. This is one that some of us still trade to this day. And Beyond Meat, like I said, it doesn't have to be a perfect white bar open and close at the exact same price because sometimes these stocks can be whippy, but that's pretty darn close. And look at that. This was the high. This is it. If you bought after this and you saw the momentum start to roll back over, this should be a warning sign that the bulls were driving this thing up. Oh, God, suddenly there was a stalemate. Now we're moving lower. That's not a good sign, and you would have saved yourself, going from $240 to $78 in the span of 3 months. And I'm not, again, these startups, these setups aren't reason enough. You don't see a doji and suddenly get scared and say, oh shit, I gotta get out. Because the bulls could have retaken control the next day or the next 2 days. You should still have rules for exits and rules for entries. It's just seeing a doji should make you pay a little more attention all of a sudden. Should make you watch that stock. A couple more. Look at this. 3 dojis. Actually, this is kind of 4. This is almost 5. That's a little big. But, you've got that long-legged doji here where the bulls and bears beat the shit out of each other and no one could win. And then afterwards, they started sending it lower. The doji isn't the important itself. It's what happens after. And you saw the bears take control after this doji. Then you saw another doji. The bulls stepped back in. We can fight. We can do it. And then they lost. That right there is a bad sign. There was 2 battlegrounds. The bulls lost both of them afterwards, and that stock, ended up cracking off. And if you saw those and if you identified what does a doji mean, it would have saved you. So, good example of doji there. Let's look at some other reliable candlestick patterns. And look, like I said, there are There are hundreds of candlestick patterns out there. Everyone's apparently come up with their own these days, and there are some weird ones. I just want to talk about a couple more just so you can kind of start to understand, well, how does the psychology of this work? The first one's a bearish engulfing pattern, and there are bullish engulfing patterns. A lot of these setups have the opposite flip side, But anyway, this is usually a chart pattern that will signal lower prices are to come, and the pattern consists of an up candlestick or like an up move, followed by a very large down candlestick that literally engulfs the smaller up candle. That black or red candle literally swallows up the other one, the highs and the lows. And I don't know about the percent here, but it's a pretty good bearish reversal indicator. It's a good reason to keep an eye on that stock if you were long, or if you were looking to short this stock. You see that, you could be like, all right, now it's time to start watching, and I might get an entry coming up here, because that means the bears have resoundingly taken control, and they have erased all levels and all progress that the bulls the previous day have made. And if they continue that down move, then they've taken control. Let's look at a quick chart example here. You can see the bearish engulfing candle happen here. Stock is grinding higher. It's trying its best. It's doing all right here. Bulls are in control. And then suddenly, wham! I mean, this candle envelops almost every candle prior to it and swallows it up, closes at the lows here. Well, look what happened. That was the beginning of a further down move. And I'm not saying if you were long through this, suddenly seeing this chart, you don't want to suddenly be like, oh God, I got to get out. But you need to now be watching. You need to decide, all right, if it breaks the low of today, if you didn't already have the idea of where your exit is, then also shame on you. But now you should really be looking and thinking, all right, if it breaks the low of today, of this day, then I need to get out. And it would have saved you having to sit through this as all of your profits were eaten away as the bears resoundingly took this thing lower with hardly any green bars in there. Another example of one is an evening star. And this is a technical chart pattern that also signals a bearish reversal. There is a flip side of this, and all of them are literally just going to be this setup flipped. And that is called a morning star. And this pattern starts with a nice tall green bar. You've got the breakout bar. The bulls are in control. We're going to new highs. The next day, the market gaps up higher on the next bar, but the buyers aren't there. Suddenly it's like, well, wait a second, we're not going anywhere. And then the gap down on the third bar and you move lower just shows you that, well, I think the bulls might have exhausted themselves and showed their hand a little early there, and everyone got excited, piled in the first day. The stalemate happened on the second day. Bears retook control on the third day. Now you're probably going to see the bulls pile out and get the hell out of the way. So I'm going to give you one moment, take a sip of water, and say, well, what does that look like on a stock chart here? Well, here's a couple examples. Stock, nice up move, pretty sizable up move here. I don't like that gaps there, but that's okay. You can't be perfect with some of these, especially with how whippy some stocks can be these days. Nice gap up after the up move. Oh God, we stalled and didn't move anywhere. Then suddenly we're moving down. You have another one here, nice gap up. The stall happens. We start moving lower. The bulls, they carried it briefly. They had a nice short and brief but strong push, and then they failed. The doji there is another great little sign. If you were paying attention, the doji, sudden quick indecision in the marketplace, and now we're suddenly moving lower. Oh God, I better get the hell out of the way. And there you go. You might have saved yourself. Talk about another setup, and this is a very, very common setup. You're going to hear this term. Look, if you're new to trading and if you watch CNBC or listen to technical traders or look at Twitter or whatever, you're going to hear this term. You're going to hear this chart is flagging. The stock is flagging. It's a bull flag, a bear flag. We're breaking out of the flag. And some of these are going to sound pretty similar to each other, and we'll talk about the differences, but I want to talk about the basic one, and this is the flag. And it's going to be exactly as it might sound. At its heart, it's a form of sideways consolidation movement. And the subset or the pieces of this flag it's going to consist of the flag pole. Flag on the ground isn't very helpful, obviously, and that's going to be a vertical move up or down in the stock or the market. And then after that nice move up, you're going to have a sideways or maybe even slightly diagonal flag. Some people call it a pennant, whatever. I don't care what you call it. Call it a banana if you want. I really don't care, so long as you understand the psychology and the thesis of why is this significant? Why have traders, traders are lazy, you need to understand. So if a trader has taken the time to sit there and name something and try to understand, and all these traders look at it, it's for a reason. And so what is that reason? Well, here is a good example of a bull flag. And the bull flag here, you've got the nice little flagpole. Obviously, it's not going to go straight vertical. No stock should be doing that. It's nice little pole here. You've got the sudden sideways movement. Suddenly the momentum stopped. We're moving sideways. Another example of a quote-unquote bear flag. A long move down, suddenly sideways movement. And this could take, notice these are different time frames. It takes several days to form, extra days to form one of the flags versus the other. These can occur at different time frames. There's no set, well, it's got to be 3 bars here and 5 bars here and whatever. You just need to be able to identify that sudden sideways movement after the nice prolonged move. Why do traders like flags? Why is this one of probably the most quoted setups out there? Well, first of all, they're easy to identify. You know what it looks like. It's got the nice move, combined with the sideways action. Also, because there's very good measurable risk reward. When you're looking at that flag, you can see where the support and the resistance are. You can understand how much you're probably risking in this stock just looking at it. You can see what the move of the pole was prior, and you can have a good estimate of, well, how much does this stock move if I decide to buy it? And they occur frequently. They occur all the time. They're on daily charts, intraday charts, pre-market, post-market. I don't care what time frame you're looking at, you're going to see flags forming. And they're easy to understand and conceptualize. It's just simply a battle is raging. This stock fought and fought and fought its way up. It grinded its way up, and suddenly it stopped. And now suddenly you've got it moving sideways because now there are sellers. Suddenly some supply has hit the market. The demand isn't quite there to overtake it. Now there's a battle forming. And, it makes what happens next that much more important. So let's talk about trading flags. Well, if the bulls are in control, suddenly it's moving higher. Then suddenly a flag forms. We stop moving up. The bears start fighting back. Maybe this is, if this is over the course of days, maybe this occurs and happens for a week or 2 weeks, and suddenly we're in a little bit of a flag there in a consolidation. Suddenly, and who knows why, maybe the sellers exhausted themselves, maybe there was a news headline, maybe the buyers were just resting, maybe a big buyer stepped in. It breaks higher and breaks the highs of these flags. That is a very good continuation pattern. Those bears stepped in and they tried to fight and they lost, and now they're going to have to get the hell out of the way. And look, I say this with all of these setups, you need to remember they are not going to be perfect shapes. They are not always going to be clean. We have HFTs out there. 90% of the market is computer trading. So there are going to be fake breakouts. There's going to be wicks. There's going to be choppiness. Keep that in mind. And definitely keep that to heart when you're trading. Typically, when you see a flag, it is a continuation pattern, but a flag forming is not a guarantee to buy. That flag may form, and the buyers just might not come back. They just might move on. The market can direct its attention to wildly around to different stocks at any given time, so keep that in mind. So when you're trading flags, many will like to see the top and bottom of the flag become the support or the resistance when you break. When that stock breaks through the resistance of the flag, and if it comes back, you want to see the top of that flag suddenly hold. You don't want to see it re-enter the body of the flag. That's usually not good. And also, you're able to easily judge, well, what's my entry? What's my stop? What is my target based on the size of the flag, the size of the flagpole? If the stock moved up 5 points over the course of a couple of weeks forming that flagpole, when that stock breaks again, you're not going to buy it and expect to get 100 points. You're not going to buy it and expect to get 20 points in that time frame. It's possible it could happen if there's some kind of news catalyst. But seeing these flags, you're able to understand, well, what is this stock really potential? What's the potential of this stock? What can this stock really do? So let's take a look at a couple of charts. Here is your first flag. You got that nice little flagpole. I didn't put the top of the pole in there for some reason. You had a little bit of a sideways movement. This isn't the cleanest one, but then you had the breakout, the continuation. and it actually pulled back and kind of tested, and then it continued higher. This is Google, so it's going to be a very kind of whippy and naughty stock. Let's look intraday. This is a beautiful flag right here on the intraday. Every bar here is 5 minutes. For the first 30 minutes to an hour, the stock marched its way higher. You had a nice little channel that we're in. I'm just kind of trying to visualize it there with the lines, and then suddenly you had a nice little pullback. The seller stepped in. You had a little bit of a battle, and then bam, it broke back out and continued higher like it was nothing. It was a great little pullback there, a little micro pullback, nice little flag form. It's beautiful. I will salute that flag because it could have made you some money. And here's another one. This one I didn't even really need to draw because you can see the flag on this one. Look at the volume surge in. This is definitely a news-based event. Every bar here is 5 minutes. The volume clearly surged. You had this stock burst out. Suddenly, we're flagging sideways, and then bam, we burst our way out, and you could have traded the little breakout here. This is a penny stock, but it doesn't matter. I know plenty of people. I trade penny stocks like this. You trade a lot of size. Congrats, it went from 250 to 320. You made 25% return on that flag break alone on your day trading. So that's an example. Now we're going to talk about something similar, and I just want to take a step and take a moment and kind of give you a little caveat here. We just talked about flags. Now we're going to talk about wedges, and then we're going to talk about triangles. And if you look at this at face value, you can be like, these setups all look really similar. These 3 setups in particular, and that's why I wanted to do flags first, because these are very similar, and they're going to have some very serious similarities, but there are some key differences, and that's why, I want you to understand that there is a difference, and technically, I don't care if you consider them all flags. That's perfectly fine, so long as you understand the psychology of these. The wedge is simply the tightening price action in the price action's direction. The stock is grinding higher or grinding lower, but the support and the resistance lines are slowly pinching together. We're making higher lows quicker than we're making higher highs, or vice versa. You're making lower highs, quicker than you're making lower lows. And, I want you to think like that as a spring slowly being compressed, and the energy of this stock is slowly being squeezed tighter and tighter and tighter. Well, as soon as that spring snaps, you're going to see a lot of energy suddenly burst out of this stock. Wedges could be rising wedges. Well, I'll give you a moment because I know some people like to write down, but I don't want to take too long on this. We're already in an hour, I just realized. The wedge could be rising, slowly going up while tightening, and I am going to show you a little graph here in the next slide that'll help you visualize a little better. The wedge could slowly be going up, or it could slowly be falling. This is going to be very similar to a flag or a triangle, so I don't want to spend too much time on this because it's going to be very easy to understand that the stock moved up, and then suddenly it stopped moving up like a flag, and maybe it continued to move up, but while it's moving up, it's getting tighter and tighter and tighter in its kind of whippiness within that up move. Or as it's kind of pulling back, it's getting tighter and tighter and tighter. And this could be a continuation or a reversal. It really depends on which way it breaks. And, take a screenshot of this right here. Take a picture if you want. You don't need to memorize this by heart. You just need to understand that, after an uptrend, you've got this little bit of kind of falling off where, it's getting tighter and tighter and tighter, and suddenly it just can't do it anymore. It's got nowhere else to go, and it breaks out. It breaks out to the upside. The people that were selling in here after this up move are now probably covering, and you'll probably see this squeeze higher. This same kind of wedge happens on the way down after a downtrend, but it's fighting, and then suddenly the bulls win, and it's over. That's probably going to be a reversal. Same kind of thing here. We're fighting on the way up. We're fighting on the way up. It breaks on the way down, and now you can kind of at least. I would hope that you would at least understand. What that means for the stock, or what that means for the market, that spring has sprung, and that kinetic energy that's built up and has coiled itself should now hopefully result in a nice fat up move or down move following. Now let's talk about one more that's kind of similar to these, and I wanted to get through these kind of quickly because I don't want to seem like I'm repeating myself here, and that is a triangle. And these are largely considered continuation patterns, but there are reversal triangles, and I've got some good examples of triangles coming up here. And it's going to be like a wedge pattern, but instead of them kind of both moving up or moving down, you're seeing the support and resistance lines are actually moving together in opposite directions. So it's not that the up move of both of the support and resistance are pointed up, just not at the same speed. It's one is pointing down or moving sideways, the other is pointing up, and they're moving towards each other. It's like a faster wedge, maybe, like this tightening is happening quicker. You're seeing it really wedge itself up in there. And a lot of people don't bother distinguishing between triangles and wedges, and that honestly, that's perfectly fine. If you kind of take all of these and consider them all triangles or flags or whatever, I don't care, so long as you're able to identify these on a chart and understand that something is happening, and you're able to look at this and understand, well, what is happening on that chart? Why is this significant? And why might this give me an opportunity to make a really good trade and make some money? And what they're going to look like is right here. Now this looks a little weird. First, you've got your ascending. I want you to imagine that these are the trend lines that you've drawn on that chart. You've got kind of that horizontal resistance with an upward sloping support. So the stock keeps bumping up against this resistance line, and every time it drops, it doesn't drop quite as far. And then it doesn't drop even further. And it drops closer and closer, and it's like pushing itself up against the ceiling. And every time it hits it, it moves, closer and closer down. If that breaks on the upside, you're going to have a whole bunch of people excited and breaking through there. And all the people that were selling up here against this are going to have to be, are going to be squeezed out. The other one is a descending. And imagine that. The horizontal support with downward sloping resistance. It drops. It bounces off this level. Maybe this is like $50 a share. It bounces up a point, drops down again, bounces up maybe 50 cents, drops down again, bounces up 25 cents, 10 cents, 5, and suddenly it's got nowhere else to go. It's got to pick a direction, and who wins here could be significant. And then you've got your sideways one, which is, both the resistance and support are moving towards each other. You see all of these all the time in day trading and investing. I don't care what you do, you're going to see something like this. It's going to be easy to identify after a while. And, you can tell that it's getting tighter and tighter and tighter. It's like that spring. It's like that coiling. It's very similar to a wedge. So how do you trade these things? Well, it's going to be pretty self-explanatory. When it breaks, like we talk about in technical analysis, you're going to want to see it hold that break level and continue going, and you're going to want to see the volume increase. If that resistance breaks and then suddenly the volume disappears and it doesn't move, well, then there's no one left to participate. As apparently this wasn't exciting, and the people aren't squeezing out of the way. So you might want to wait a moment and wait and see, well, is this going to continue higher? If it breaks that important resistance level, if that ascending triangle breaks and it pulls back and that resistance doesn't turn into support, and now suddenly we're back in the body of the triangle, well, what the hell is this thing going to do now? Who knows? They're all pretty straightforward with wedges and breakouts. It's pretty easy if you to understand if you want to trade the breakouts of here. Well, what about, saying, hey, Nick, I'm pretty impatient. I want to trade in here. I want to trade in here. I'm a scalper. You absolutely can. I know several traders who, make very good money. They'll see a triangle forming like this, and they'll sell up here. They'll buy up here. They'll sell up here. They'll buy up here. And obviously the profit, every time is going to get less and less, and they won't do it every single time. And, they know their stop. Well, if it suddenly breaks this triangle, I'm going to get the hell out. But you can absolutely scalp the range of a triangle. That's probably a little more advanced to some degree. Or you could just trade the breakout. So let's take a look at some actual stock charts of triangles. Bam, this is on the daily here, CBOE. You've got kind of the tightening resistance, the tightening support. And like I said, look, you're going to have wicks like this. You're going to have fake outs like this. You're going to have moments where it might look like it's going to break. The close, in my opinion, is much more important because the Bears tried to break it out and they couldn't do it. That makes this triangle more significant, in my opinion. But, we eventually broke out. This tightening happened, and then finally we broke out. You saw a little bit of a surge in volume, and that led to a nice sustained up move. Let's see another one, tightening. We bounced a little higher, bounced a little higher, bounced a little higher. Meanwhile, we're bouncing lower off of a ceiling, and eventually it's got to go, and it breaks to the downside, and that led to, going from 94 down to 68 in the matter of 2 months. Nice little haircut there. let's look at a descending triangle. That is, you've got a pretty decent support line here at 16. You know, the stock tried once to break out, couldn't do it, held pretty nicely on 16. You know, we do have some wicks, and that's not ideal, but, you know, not unexpected. Meanwhile, it's not able to bounce off of this support level, and it's bouncing lower and lower and lower and lower, and then suddenly it just breaks. And this break, this surge of volume as we break, that's great. Look at that beautiful triangle break. It goes from 16 down to 9. It probably kept going. You almost got 50% on the way down here, obviously if you held for 2 months or whatever your target was. But you know, that's a great little sign there. Let's take a look at another descending triangle. Nice support here, 12 bucks. Held, can't hold below. And like I said, wicks happen. You know, what I focus on is, you know, did it close back up in here? And, you know, were they able to keep it down there? They weren't able to keep it down here. And meanwhile, we're getting tighter and tighter and tighter, and it broke. And then you had earnings, and thankfully earnings were bad, and it broke further. And you got, you know, 5 points, so you almost got 50% in the matter of weeks on this one. So that's a good example of flags, wedges, triangles, you know, a couple different kinds of chart setups there. Now let's get into some fancier setups, I guess you could say, a little more specific. The first one is the double top and the double bottom. And you might think you understand them, but I want to make sure that, you know, we really understand some of these. And some of these may seem weird or complex, but they are significant, and they are parts of larger setups sometimes. So first off, the double top. I want you, and I'm going to talk, I like to talk you through this sometimes so that you can understand it a little better, and then I show you on the charts. So imagine this stock goes up and it hits resistance, it hits the highs. Suddenly that stock pulls back. That's fine, it happens. It bounces back up, hits that exact same level a second time, and then pulls back again. That's starting to form a double top. Now, you don't just assume, oh, it's touched a high twice, it's a double top. You might want to wait, obviously, because there's caveats that I'm going to talk about, because this could be the beginning of sideways consolidation. And the double bottom is going to be opposite. And like you'd probably imagine from my beautiful illustrations there on the right, a lot of times they're going to be shaped like an M or a W. You can see, you know, that it went up, hit resistance, pulled back, went up, hit resistance again, and pulled back, and, you know, you've got kind of the line in the sand on either side. Now, you know, some easy ways and some tools to use in these double tops and bottoms is volume. You know, you want to see lower volume on the moves in the original direction. Typically, if you see a double top or a double bottom, they typically are reversal patterns because, you know, the buyers drove it up, bulls pulled it back down. Buyers tried a second time, and the bears pulled them back down. And usually that'll lead to the buyers giving up and exhausting themselves. And you want to see higher volume on the reversal and the reversal of directions, because if that higher volume is on the way down, that means there's more bears that are more eager to drive this thing down than there are buyers who are going to try to push it back up. So how do you trade these things? Well, look, like I said, it could just be the beginning of this stock bouncing around. You don't want to get chopped up because you tried to jump the gun. So what you can do is use the top or the bottom of this double top and double bottom to determine, all right, well, you know, it's set up this M-shaped formation. If it breaks the bottom of the M, I'll get in, and my stop will just simply be the top of the M. And, you know, how long do I want to hold this for? Well, how big is the size of this M? Is it several points? Is it several cents? You know, then that can kind of give you a sense of, well, how far can this go? Let's just take a look at it on some charts. Look, like I said, some of these might seem complex. You might be a little confused or scratching your head on some, but the more you see them, the more repetition you get, the more relentless you are in your learning, the more you'll get it. This is a decent double top. You know, look, the bulls drove it up. They pulled it back down. You know, it's not going to go down and right back up. They pulled it down. They drove it up again, failed, and then they failed. This might have been a news catalyst that sent it down here. It doesn't matter. You know why? Because they tried to drive it back up, and they failed at the bottom of this M, and they started rolling it back over. You can see this nice double top. You see the bears put up a fight. Something happened where the bulls gave the hell up, and they couldn't bring it back up, and that was the beginning of the end for this stock. Another one. This is a pretty good M. You can see the move up, the move back down, the move up, both touching the same price here, and then suddenly they just couldn't do it anymore. And, you know, there's some chop within here, but you can see the general flow of the stock that they tried to drive this up twice. They failed both times. The bears took back control, and then that just led to the slow death of this company. I don't want to be over-exaggerate there, but, you know. Here's a nice double bottom. You know, they brought it back down, and this was already a key support level. You know, this doesn't need to be a new level. They drove it down, bounced off of it, you know, put a little bit of a peak here, drove it back down, which is fine, you know, and then they brought it back up, and they kept going. And as soon as they kept going, as soon as you saw that push away, you know, you understand, well, this stock might be reversing, and reverse this one did. Another double bottom, this one, you know, looking okay, pulled back, bounced, pulled back, bounced. I'm not going to hit you over the head with some of these charts because I've got some charts and some setups I like a little better coming up here on some of these other ones. Here's another double top. This one's pretty good. You know, we popped our way up. They drove us back down. They popped our way up again, and they drove us back down, and that was all she wrote. People gave up on the stock. You know, this happens on small price stocks, big price stocks. You'll see it in the intraday. You'll see it on the daily. I tend to put up daily charts here just because sometimes they're cleaner, and sometimes they just look better. But this could be an intraday chart for all you know. You know, these bars could be minute bars. So let's talk about, and this next one is probably one of my favorite chart setups. I don't know why, but I tend to take these the most, especially if I see them. And this is the head and shoulders, or the inverse head and shoulders. And you know, it's a funny name for a chart setup if you've never heard of it, but you'll understand that they are for a reason and they mean something significant. The head and shoulders pattern. It could be a potential reversal signal. It doesn't mean that if you see this forming, you jump the gun and anticipate necessarily. You want price action, you want confirmation, like everything. And when you look at them, they're going to be pretty similar in shape to that M or that W, that double top and that double bottom. But there's going to be an extra important step there. And as you probably imagined, a lot of these are named because of what they look like. Traders are not creative people. Many of us are stupid. That is why we are trying to make our own money and not work for someone else. So, look, you know, the double top and the double bottom are named because there's a double top and a double bottom. Well, the head and shoulders pattern is going to be named because, look, you see a beautiful smiling head there and two big, broad, rounded shoulders. It's like looking in a mirror, isn't it? And so this is why it's literally called the head and shoulders pattern, is because, you know, it's got a little head. You can see the neck forming, and you see the shoulders and the neckline, and that is a beautiful thing to trade off of sometimes. So, you know, what does this mean? What is the head and shoulders, and what is it comprised of, and how do you trade this thing? Well, it may sound complicated, but the more you see it, trust me, the easier it's going to get. And some important notes to keep in mind, like any human who is going to be considered attractive, or, you know, any kind of attractive setup, you want the neckline to be relatively even and horizontal, and you want generally even shoulder height. You know, you want to look at this chart and you want to be like, yeah, I can see it. I can see the fight. I can see where the bulls are. I can see where the bears are. You know, and the cleaner it is, the more obvious the levels, the more significant those levels can be. I'm not saying they have to be perfect, but, you know, the more perfect you are, probably the higher win rate you'll have, because you're going to be pickier and, you know, you're going to find the ones that look the best. So that's generally, you can see the head and shoulders. Beautiful little head, two beautiful shoulders, and then we broke. You know, you could put two eyes and a little smiley face there, and then you've got the arms coming down. What about the inverse head and shoulders? Well, like every stock chart out there, or setup out there, it's just simply the same thing but flipped upside down. Imagine that man is up on his head. Some of us, you know, that's kind of how we trade on our heads sometimes. I swear to God, I see some trades out there that make me think that people are trading with their feet. So who knows? And this means that this move lower might end up reversing to the upside. And the same rules are going to apply. They always apply. You know, nothing changes. You want that generally even neckline and shoulder line. You want to be able to see where the battle is raging on. So, all right, you understand that you can see a pretty little face in the chart. You know, how do you trade it? You know, what's the significance of this? Just because you see it. With anything here, just because you see it doesn't mean I got to buy or I got to sell. You want other indicators. You want other important notes there. You need price action to confirm price is king. Well, obviously the key levels here are going to be the neckline and the shoulder line. you're going to want to look at those big levels. You're going to want to see, well, how big of a neck does this guy have? How broad are these shoulders, and what are the levels to look at? And it's going to be a case by case basis, but you're going to want to get good risk reward. There we go. We worked it out there, folks. Obviously, if the neckline and the shoulder line is huge, and this is some huge setup, and if you were to buy this thing here or sell this thing here, your stop would be way more than is comfortable. Well, then don't trade it. We're not trying to say every setup is going to be what you want to take. You're going to want to have your own rules on something like this, obviously. And a lot of times when you're trading these, using the distance from the neckline to the head, or the neckline to the shoulders, or other important levels up ahead, using momentum to trade this thing, that's really what's going to help you. If the bottom of the neckline up to the head is 10 points, is $10, then how are you going to want to short on that break and expect to make $50 or $60? If you've got an inverse head and shoulders, and from the shoulder to the neckline is $5, you need to understand, well, if this stock is, this is the extent that this stock is moving in here, you can use that to try to get an understanding of, well, how far can this stock move? If this head and shoulders formed and you shorted on the break, and there's massive support down here, I mean, we're talking, this is a level this stock hasn't been able to break in years. Well, obviously, you want to be careful. You want to probably not expect it to go much further than that. Maybe it will. Maybe it's the start of it finally breaking that level. In that case, great for you. But you got to be wary of that. So let's take a look at some head and shoulders on some actual charts, won't we? First one is Michael's. I believe this is that, crafting store that my wife probably spends too much money at and keeps afloat herself. But you can see the head and shoulders pattern. One nice little shoulder here. He's got a little bit of a growth in his shoulders. That's okay. You could probably include those in the shoulder line. You've got a nice, pretty little head up there. You can see the support line here. Look at the support on this nice neckline. You can relatively see the shoulder line. And then we break. And that break, it tries to get back up, it can't, and that's the beginning of the end for this stock. And it goes from 24 all the way down, comes crashing down, and it hasn't reclaimed it. So nice, beautiful sign of the top there. The bulls were in control, and then they drove it back down. They couldn't get back above this previous resistance, and that was all she wrote. Let's look at another head and shoulders. One good shoulder, two good shoulders. There's a little bit of a peak of a head sitting in there. You've got very clear support in here where the bulls would step back in. Suddenly the bulls were gone. And it actually tried to drive back up and failed. That support, if you watched yesterday's episode and you remember how support and resistance is supposed to work, that support level broke, became resistance. This is the most beautiful chart I've ever seen. It brings a tear to my eye. Turtle Beach here. Look, the bulls were greatly in control. They took it from $1.64 to $34. Nice job. But looks like your time is over. The head and shoulders signified that turnover in supply and demand, and you could have seen that short coming. What about an inverse head and shoulders? Well, here you go. Very clear level here. They tried to bring it up. They couldn't do it. You've got the nice head there, and as soon as it broke, it continued higher. It looks like you have a nice bit of sideways consolidation here. I'm curious what it did after. Another inverse head and shoulder. And I like to try to do this, because I realize that I might be accidentally making you think by showing you all of these examples of it working that, you would suddenly think, well, if it does this, then it's going to work. They don't always work. It happens. You're going to be wrong. So here's an example of a beautiful inverse head and shoulders. It broke out and it failed. Hey, you know what? It's all right. The bulls tried to squeeze him out. The bears re-smacked it back down and said, no, we're not done with it yet. And that happens. That's why if you were to have bought this here, in anticipation of the continuation, you could have used this neckline as your stop. You could have used the shoulder line. And if you followed your plan, you got stopped out. You said, it happens. Those are beautiful inverse head and shoulders, but it didn't work out. Who cares? Move on to the next one. Be relentless. And that was a beautiful inverse head and shoulders. And you got the break. You even got a little bit of a continuation. You got almost 6 points on it. So it's not like it didn't look like it was going to work, but sometimes it doesn't work. And actually, it might have worked. This is earnings right here. They had really bad earnings that drove them down. So it might have worked, but you had a news catalyst that changed the picture. It changed the story, and sometimes that happens. Sometimes there's nothing you can do. You can't predict when a news catalyst is going to break. I mean, when earnings are going to happen, so you got to keep that in mind, obviously, but that'll happen from time to time. Now, this is something that, I've talked about trading breakouts and investing in breakouts and, what qualifies a good breakout. Well, I just want to make sure we're all under the same understanding as, what is a breakout and, why is it important that you identify when a breakout is occurring, because this can be the beginning of a major, major move for a stock. This could be the beginning of a beautiful trade. This should be a directional trader's favorite part of the trade because this is it. You've caught it on the moment. You've caught it when it's finally starting to take its step out on the wild side. And what happens is this stock is finally moving out of a level or several levels it has been stuck at for some time. You're looking at that flag, that wedge, that engulfing pattern, whatever, that head and shoulders, and you're seeing it finally break the neckline. Well, the breakout's happening. It's simply breaking past that clear support and resistance level. I would like to think that the word breakout makes it pretty self-explanatory here. And breakouts are great because they can occur in any market environment. And it's really, really nice and really kind of important that you get a big increase in volume with that breakout. If that stock finally breaks through resistance, you want to see that surge in green volume. You want to see the buyers flood in there. You want other participants in that stock. I know you might think that you want to be the only one to see this breakout and be the only one to catch it. But if you're the only one in it, it's not going to go anywhere because it needs other buyers, obviously. The more buyers there are, the more volume there is, the better potential that this breakout's going to work, baby. And you also want to see that resistance come back and test, hopefully. And that resistance will turn to support. It doesn't always happen, but that's part of the game. So when we're trading breakouts, it may seem easy, right? Wrong. It's not as easy. There are fake breakouts. There's unclean breakouts. You're going to get tricked in sometimes. You're going to get tricked. You're going to think you see the perfect setup, and suddenly it's almost as if they were waiting for you to enter. I hate to break it to you, but there is manipulation in the market. I'm going to put on my tinfoil hat first and make sure the government's not listening, because I know there's manipulation out there, and it happens. You're going to see it, and it's going to be weird. So long as you know your entry and exit rules ahead of time, you're fine. Who cares? So they're going to work more than they don't. You're going to have a nice, successful trading system, especially if you're able to identify the breakouts. What is one way to help avoid issues like this? Well, waiting for confirmation. Maybe it breaks through resistance. You needed to spend a certain amount of time up there. Maybe you need a certain amount of volume. Maybe you need price action, the retesting of the level. The more confirmation, the more check marks you get in your favor, the better, and the more likely you're going to succeed on that trade. And I want to talk about, well, when you're trading breakouts, obviously it's not as cut and dry because there's a little bit of a battle here. Because if you wait too long, you're going to miss it. And if you're too early, then you risk it being a fake breakout. So you need to really have that balance, obviously. This is kind of self-explanatory. I'm going to show you some breakout examples, and then we're going to move into some other interesting stuff here other than chart setups. Know the size of the consolidation, the important levels. It's all factors to take into consideration. The time spent consolidating. How long has this spring been coiling? The longer it's been consolidating, the more likely that shit's going to move really nice when it finally pops. So keep all of that in mind, obviously. Some of this is pretty kind of common knowledge, or, it's something that you can infer just by looking at it, but it's important to make sure you understand, the risks and the value of breakouts. So let's look at some charts here. Nice little consolidation in AIG. I think I've shown a similar chart before. In fact, it may have been this chart. Beautiful resistance, beautiful support, clear consolidation here. We break out to the downside. And lo and behold, right in here, you get a surge in volume. It's not the biggest surge in volume you've ever seen, but a nice little surge in volume tells you there's other sellers participating. The buyers are getting the hell out of the way. And it tried to bounce it. It would have been nice if it tested up here. It's not going to be perfect, but you had a little moment in here. You had a couple days of it holding down here, and you saw it start to turn back over. Could have been a nice little trade. Let's look at another one. Lows, and this is a perfect one because you get a fake breakout and a breakout all at the same time. Nice little range here, beautiful support at 85. It was support right here, or resistance here. It became support. It became support again. We broke out on the downside. No one was there to take it out. You got a little uptick in volume, nothing too serious, and no one was there to continue it on. It ended up coming back in, and then lo and behold, some earnings come out. It pops back out. Now you've got a news catalyst and some catalyst to break it back out on the upside. Let's look at another breakout chart. Sideways action. Breaks its way out. It tests back and it does come back into the move a little more than we would probably like, but as soon as you see it re-break out, I mean, that's beautiful right there. That is, borderline textbook on a breakout here. Beautiful little consolidation. Breaks back out. They try to drive it back in. They can't do it. The sellers retake control and off you go. Here's a little bit of a breakout, on kind of an up move, an upward trending channel in McDonald's. You can see this upward trend. It's bouncing, 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 and finally it can't do it anymore. And the second this channel breaks, that ends up being the sell-off, the selling point. And I'm not saying you should have shorted here, but if you were long in here, that was a great time to maybe start examining your exit points. None of this is reason enough by itself to trade, but it's time to start examining. And I wanted to kind of break up these charts to help give a little refresher, a little important note on trend lines, because I realized, I was talking a lot about this, and about halfway through the presentation, I was like, oh my God, I don't know. I can't assume that everyone watching this understands what makes a good trend line and why this is important. So I'm going to do a quick little refresher on trend lines. It's basically like support and resistance. So if you've watched that class yesterday, you'll have a general understanding of this because it's the most basic tool for technical traders. We are simply talking diagonal support or resistance lines, and you can consider a horizontal support and resistance a trend line to an extent as well. We're making consistent higher highs or higher lows, or the opposite over time. You can see it moving up. You can see the bounces happening higher or happening lower. And generally, there are going to be some rules with this. So when we're looking at the quote-unquote rules, you at least want the 2 points to connect to form the quote-unquote trend line. That's when you're thinking, okay, we may have a trend line here. It's touched twice. Who knows? Then you get that third touch, and you're like, all right, now it looks like we're starting to get a trend line. You can extend that line further and start to anticipate and start to plan ahead. The spacing of the touches would hopefully be relatively even. It should not violate these lines, but remember, there's computers out there, there's algos, HFTs, nothing's going to be perfect. It can be intraday or over multiple days, okay? So everyone should hopefully at least have an understanding of the concept of trend lines. The buyers are stepping back in at higher points. They're stepping back in quicker than before. They're anticipating a little quicker, or the sellers are overwhelming a little quicker than before, and they're slowly making lower highs. So understanding trend lines is going to be important. Just giving you a mathematical perspective of trend lines, drawing trend lines can really help because they can help you determine the slope of that trend up or that trend down. You can understand, well, how fast is this up move? How fast is this down move? Looking at a chart is one thing, but drawing that line and physically seeing how steep that line is can really give you a nice visual cue as to how fast the stock is moving up or down. If the stock is grinding higher, that trend line will be running along the bottom of the move. You want to see, well, where's the support supposed to be? Because then you can find, well, when that support's gone, all right, now it might be time for that stock to roll over. Opposite for a trend line on the way down, it's going to be tracing down off the highs. You want to see where that resistance is, because when it does finally break that resistance, now we might be looking into either consolidation or a reversal. So that's why we draw the trend lines, and that's kind of the key importance there. So looking at some charts, I don't want to hit you over the head with something, kind of simple and rudimentary, but it's important that you understand the basics here of trend lines, because look, all of this stuff, builds off of each other. And here's a pretty good example of a trend line. It bounces again, it bounces again, and at this point you could probably look, it even gets below, and that trend line briefly becomes resistance, but gets back above. You can then extend that line. You could have drawn the line after these couple of days, and then a couple of days later it touches again, it touches again, it touches again, and then maybe here it cracks through. That would have been a good time to maybe start looking for a reversal. Or if you see this uptrending Microsoft and you're like, well, where can I buy? And you see it come back to this trend line and touch, that might not be a bad time to, once you get confirmation based on your rules and your indicators and whatever, to start looking for a buy. Otherwise, how else are you supposed to know when to buy into a strong stock? Another trend line on the way down. Boom, resistance, comes back down, tries to drive back up, shorter resistance, tries to drive back up, shorter resistance, shorter resistance, shorter resistance. And this trend line continued. Every dotted line here is a year. This trend line went on for years, and it finally broke. I should have extended that off. Why didn't I extend the line? Because you can see it broke to the upside. Now you might get a nice little rebound in silver. And now silver suddenly is broken out of this descending trend line, and you might get a little bit of a reversal here. Just as a reminder, support and resistance, you can get these nice little horizontal lines. Nice resistance, resistance, resistance. It breaks out. It broke out. We talked about breakouts. Broke out of the resistance. It came back and it tested it. Oh my God, if you saw this chart set up, you should be salivating here. Look at this, sideways momentum. It breaks out, gives you a nice, another little kind of almost little flag up here with another little sideways move, and then it takes off and it goes from 20 to 40 in a span of a couple of months. Beautiful trade, depending on what your trading style is, but a nice example of trend lines. Another example of trend lines, 48, 40, bouncing back and forth for months at a time here, and that's how it works. And now we're going to talk about, well, we've been looking at these trend lines. Well, what would we call this right here? Well, it's technically a channel. And these channels are exactly as you would think they are based on the charts that we've been seeing and based on trend lines. It is just simply the stock moving in a certain direction with the corresponding support and resistance lines. It could be sideways. It could be at an angle. This is literally what your trend lines would look like. This can happen on any time frame. The lines need to be parallel to each other. You don't want them moving closer to each other because then that's not a channel. Obviously, that's a wedge, and that wedge is slowly springing, and it's going to coil and snap. The channel isn't getting closer to each other necessarily. This channel could be occurring for months at a time, hours at a time, days at a time, depending on what time frame you're looking for. And channels can give you really good trading opportunities. You might think, well, why am I going over this? Because you can get some really good trades off of channels. And the way that you can trade off of channels is two ways. You could trade within the channels. Yes, you absolutely can. You see this channel forming, you decide to buy in here and maybe sell when it gets to the midpoint of the channel, or sell up here and cover when it pulls back a little bit. And then you've got an automatic trailing stop as the channel is moving lower with you or higher with you, or you can wait and trade the breakout of the channel and then the retest of the channel on the other side. There's multiple ways you can trade these things. And we've looked, you've been seeing several channels on my chart examples and you didn't even realize it. So let me pull up some of the old charts that I've been showing you, and you're going to pretty easily be able to identify this was a beautiful channel in AIG for 7 months. 7 months this stock moved sideways. You can see the support. You can see the resistance. It wasn't moving closer. It wasn't slowly moving tighter and tighter. It was just moving sideways. And you could have, traded off of the ends of the channel or traded within here if you wanted absolutely. Or you could have waited for the channel to break, and that was a pretty significant move. Another channel example, AKAM. Look at this beautiful channel moving sideways. You can almost argue that this is a flag. After a nice solid move up, it starts moving sideways. You got nice support, you've got nice resistance. Wait for it to break on either side. Trade within there. I don't care so long as you have a system. And then I've showed you Amazon. Look at this nice upward channel here. I didn't just arbitrarily draw this line. You could have seen this and seen this and seen this and drawn the line and then, extended it off on its own. And then when it broke, this channel suddenly became resistance, and they tried to bring it back into the channel. They tried their best and they failed. And as soon as you saw them fail here, that was a nice little 25% drop that Amazon saw in the span of a month. Sometimes it's as simple as that. And you figure out, well, based on my trading system, where do I want my stop to be, my entry, what's the the distance I'm looking for, and that's all well and good. And you can find all sorts of things. I've already showed you this McDonald's chart, another channel on the way up. It finally broke the channel on the way down, did a little dance, made a little love, and then it dropped like a rock, and you had another great trade. Let's look at another one just for shits and giggles. Procter & Gamble, channel up, and I do like to show you ones that don't work. Because look, every stock is not going to work. Every setup is not going to be perfect. You had a false breakout here. Sorry, didn't work. You had a false breakout here. Sorry, this one might have worked, but then it had earnings. And the earnings sent it right back up into the channel. Damn, that sucks, because that looked like it was going to be a good one, but It happens, you know. You got to understand when news items are coming out for stocks and prepare yourself accordingly, because it could ruin your plan. That earnings, you know, could have sent you down. Regardless, beautiful channel. Didn't work. That's the name of the game. You know, we are in the numbers business here. Most people aren't even going to have a 50% win rate, but damn, that was a beautiful channel. And it still is. Third time could be the charm on this channel break. Who knows? So now I've talked about some stock setups. I've talked about candlesticks until I was blue in the face. Literally, we've been going for an hour and a half, so I want to now, wind this down with some indicators. And the indicators I'm going to talk about today, and I think these are the only indicators I talk about today, and we're going to talk about more tomorrow, is moving averages. A lot of people understand what an average is. A lot of people understand what a moving average is, but I want you to understand what is that, what does it mean, how can you use this in your trading, and how do we use it in our trading? Because if you watch our shows, we have moving averages on our screens all the time. Every chart I have on my screen has a moving average of some kind, more specifically a specific moving average, which I'm going to talk about in a moment. But first off, for those who don't really understand what a moving average is, it is one of the most used technical studies out there because it's pretty simple. It's pretty simple to understand. In fact, many of them are called simple moving averages. There you go. We're not making it hard here. It literally has simple in the name. It can't be hard, right? And most people, you could use this alone, or more specifically, you could use it alongside other moving averages. You could have multiple moving averages on there or other indicators. And a simple moving average is you're just simply taking the average of the price over an X amount of time. If it's a 5 simple moving average, you're taking the average over the last 5 bars. And usually if it's a bar, they're going to take the close of that bar when they calculate the average for the bar. They don't try to take into account every single trade. That would be, insane computational and unnecessary. So they take the close of this bar and the close of this bar, the close of this bar and the close of this bar, and they average them together to figure out where that line is going. So the simple moving average is just going to be taking the simple average of this stock for the last X periods, every new X period. And, it may sound weird with the X in there, but I'll give you some examples and we'll look at them on some charts and how you could have used them to trade. And then it's connecting all of these averages with a line. That's it. And this line is just simply there to show you the change over time. A candlestick chart might be pretty whippy and might be hard to read sometimes, and there could be wicks and things moving around. Well, you may like what a line chart looks like, but that line chart isn't going to show you shit in terms of highs and lows, so you put a simple moving average on there, because that simple moving average really helps you visualize, well, the average is moving up. The momentum is gaining speed as that moving average starts to curl up higher and higher as the chart moves higher and higher. It is a visual representation of what the average price is doing. And if the average price is moving up, that is a good sign for you longs. An example, the 4-period SMA, simple moving average, on the daily chart. That just means that every day that moving average takes the average of that day's close plus the close for the last 3 days, it combines them together, and it divides that number by 4, and that is the average over the last 4 days. And it does that every single day. And then it connects those dots with a line, and then you can visualize the average is rising and falling. The 4-day average of this stock is rising and falling. And then you can visualize where the momentum is, and you can use that to understand where the stock is going. You can use this on the daily, you can use this on the intraday, you can use this wherever the hell you want. It's easy, it's just averages, it's math. So when you're trading with simple moving averages, rarely will a trader just use this simple moving average to decide, the simple moving average is pointing up, so I'm going to buy. But it can help influence your decision making. If a stock is moving completely flat and that moving average is flatlined, it's kind of flatlined like a dead person. That stock has no action. It's probably not going to be fun, so you might not want to buy it. Maybe you start to see the moving average curl up. It could be a sign that you might start to get some action in that stock. Some traders have rules based on simple moving averages. They won't buy a stock if it's trading below its 50-day simple moving average, or they won't short a stock if it's above its 50-day simple moving average, because it's just that. It's higher than its average. It's doing better than the average of the past 50 days. So some people like to have rules for their system based on moving averages. And when you're applying the simple moving average, you could have it on any time frame you want. Now, remember, it is a simple moving average. It is simple to understand, but it is also simple in what it tells you. And the time back determines how tightly it will fit the price. If you're looking at the average over the last 2 days, then it's clearly going to be very tight to the price action. If you're looking at the average over the last 200 days, you might be trading far away from that line because there's a lot of variation within 200 days. And I'm going to show you some charts in a moment. So these are some of the most commonly used ones out there. If you're looking at like a daily, you'll see a lot of people use 50, 100, 200s. Then we get a little closer in there. You could use 5, 10, 20, 50. It's really up to you. There's no set rule on what you should use. You know, try trading with trading for a month with a 20 on there or a 5 on there. And if you don't like that, maybe try a 30 or a 50 or a 100 and just see what really fits your personality. Moving averages might not fit your personality at all. That's perfectly fine. Let's look at an example. Here's a nice a 10-day, 10-period simple moving average on the daily, which means every point in time right here, you know, the moving average took the average of this day plus the last 9 days, it combined them together, it divided by 10, and it got that point right there. And it did the same thing every day, and that's how you got it. So you can see the moving average move. If someone's trying to invest in a stock, they might have a rule, I'm not going to buy that stock if it's below its 10-day. That would be a little tight for, you know, investing. But, you know, if it's below its 10-day, then clearly the momentum is on the downside, and vice versa. You know, that's one way you can use it. Now let's show you the example of using different period SMAs and being able to see how tightly it fits the price action. The purple line here is the 9-period simple moving average. The blue line is the 30. Look how much further the price action can get from the blue line. The blue line is a lot smoother. You know, it's not as whippy and crazy as the purple line. And I'm not saying the blue line's better. They both can be used for separate purposes, you know. And then let me zoom on out further and show you this is a 10, a 50, and a 200 period SMA. Now this is what a lot of my daily charts will look like this. I think I have a 20, a 50, and a 200 on mine. And this 200 is literally the average of the last 200 days of trading. Look how good the support was on this 200-day simple moving average. The bigger the average, the more important that level might be to some traders or to algo traders or to computers, because that's a more significant average. And, you know, some traders will have opinions when moving averages cross over. When this 10 period crosses over the 50, that means the short-term momentum and average is now rising a lot faster than the medium term. You know, so you can use these different moving averages to get a visual sense. Remember earlier in this lesson I talked about multiple time frame analysis? These moving averages are almost telling you what the multiple time frame analysis is going to tell you. The 200-day analysis is slowly grinding higher. The 50-day, you know, got a little flat in here but curled back up. And your faster, whippier 10-day, you know, is going all over the place and will help refine the momentum. We're almost at the end. I promise you we're getting a little long here, but you know, this is a lot of content. I really want to get you as much stuff as I can in here. Exponential moving averages, this is going to be very, very similar to simple moving averages, but it has a higher weighting or significance on recent price action. So if it's a 10-period simple moving average, it's going to take the last 2 or 3 bars more. It's going to put more weight on those pricing. The theory here is that the more recent price action is more important, and that price action that's happened a little later, you know, isn't going to be as important. And so this line is going to follow the price action a little better, and it's going to be a little tighter to the bars, and it's not going, you know, the chart's not going to be able to move away from it as fast. And, you know, some people like EMAs better than SMAs. I'm pretty sure Mike likes EMAs better than SMAs. That's perfectly fine. Plenty of people like one or the other. And, you know, it really depends on your preference here. So here's a good example of a 50-period simple moving average versus a 50-period exponential moving average. The 50-period EMA, the pink one, hugs the price and reacts to price changing quicker than the blue one does. Its change and its shifting with the price happens and occurs more frequently and quicker because it takes more weight on this recent breakout here. This breakout here pulled this pink one up a lot faster. Look how the EMA became really nice support in here. You know, it really cradled this price action. It was nice resistance in here, you know, nice resistance in here. You saw it actually bounce off of the EMA several times. This happens all the time. So some people like EMAs better. I don't think there's any right or wrong answer, frankly. I think it's whatever fits your trading style and your personality. Now I want to talk about what is personally my favorite moving average out there. This is one that I have on all of my charts when I'm day trading. I know a lot of traders that use this indicator. I know a lot of traders that don't use this indicator. I'm not advocating for VWAP. I'm not, you know, parading it. I'm not cheering it along. I just want to, you know, let you know what this is because a lot of people use it. A lot of people quote it. A lot of people might say VWAP or VWAP or however the hell you want to say that. I know there was a recent song that came out that is not going to give this a very good connotation, but, you know, VWAP is going to be a pretty significant line. And this is the volume weighted average price. And this is simply a moving average that does not give all equal weighting to all of the price action. It doesn't give stronger weighting to the recent pricing. Instead, it considers volume done when it weights. So if more volume is done at one price level than the other, it's going to weight that more volume price level more heavily than the other one. It is a very complex equation. I don't even think I could recreate it. I don't even know. Some VWAP, some people might calculate it differently based on, I don't even know, but it weights volume in with that when it's creating that average. And let's just kind of conceptualize this. If the stock has had 2 trades execute, now obviously a very thinly traded stock, but one trade executed for 100 shares at $10 a stock. The other trade executed for 100,000 shares at $10.50 a stock. That 1050 should have more significance and have a higher weight on the average than the $10 a share execution because so much more volume was done there. So, you know, the VWAP will have much higher weighting on that price, and that will influence the moving average a lot more. Some VWAPs take into consideration pre-market when they calculate the VWAP, and that's perfectly fine. A lot of volume doesn't usually happen in pre-market, so that usually won't weight the VWAP that much. So it's something important to keep into consideration. Let's give us another example here. Let's say we're looking at a 10-period simple moving average with 1-minute pars. And over the last 10 minutes, you've had trades at 10, 10, 10, 10, 20, pretty much a nice little tight range here, but you had one crazy trade at 12. That $12 print would have an equal weighting among simple moving averages. It would have a higher weighting among exponential moving averages. But what if it was a rogue print or only one share executed at $12? You know, it's just one share. It wasn't that significant to some people. Well, VWAP would smooth all of this out if that $12 a stock trade was a lot smaller than all of the other trades that executed on this share, on this stock over the last 10 minutes. So it's going to take volume into consideration. Now, why do I like VWAP? Why is this such a big consideration? This is our last slide before our closing remarks here. We are at the finish line. Well, technical analysis, we talk about price and we talk about volume. The use of volume can give it more significance. I love VWAP when I'm day trading personally. You don't have to use it to influence your decisions, but you can make rules based on it. You could use it as a trailing stop when you're long something. Use it however you want. A lot of big firms used to use VWAP very heavily, and I'm talking like the big funds, the big analysts. They used to be graded on their executions based on where they executed their trades in relation to VWAP. Some of them may still do that. I don't know anyone who works at any of these big firms anymore, so I don't know. But there are VWAP-based orders that will slowly execute large trades as it approaches VWAP. I'm serious. VWAP's used by a lot of people out there, which is why I wanted to give it its own section and its own dedication here. Volume is a big deal when it comes to technical analysis. Other than that, you don't use it differently than other moving averages. It's just another type of moving average. So it's something that I wanted to bring up. I could have talked about this tomorrow in professional indicators, but I just wanted to kind of get that out there to you. All right, you know what? We've been going for almost 2 hours here, so let's get some closing remarks here. And then I'm going to let you all go. We'll have another class tomorrow and some more technical stuff. It will not be as long as this one, I promise you. But there was a lot of information here. The closing remarks are, look, a ton of technical indicators and things that you can use are out there. Today's class, while it was 2 hours, has hardly scratched the surface. Oh my God, there is so much stuff out there. It would blow your mind how many different indicators and moving averages people have thought up of all sorts of math shit out there that I wouldn't even have been able to dream up of. You can find all sorts of stuff. It's not really, the indicator itself. It's just important to know, what are these things telling me? When an engulfing pattern happens, or when a consolidation is happening, a flag, a wedge, whatever, when that's forming, what does that mean? It means that there's a battle happening between the buyers and the sellers. There's a lot going on. These things are here to help you understand the psychology of the stock. And you're also here to use them in conjunction with other indicators, but not too many. You don't want a noisy chart. And they're used to inform. Everything in technical analysis is used to inform, not to dictate decision. Unless you really sit there and create a system rule-based trading setup where you have very specific rules of, it crosses this and this does this and this is here, I buy, and this is automatically calculated for my, my entry and exit. If you want to, that's robotic trading in its sense, and you can do stuff like that. That's perfectly fine. But when we're using technical analysis on stocks and charts, we're using these things to help give us a clearer picture and to help us try to understand some things and give us just a little bit of a better glimpse through the keyhole and a little bit of a better picture of the whole thing. It's not going to be able to give us the full scope of things. We're still going to be wrong. I have moving averages and I have things on my chart, and guess what? I'm wrong. It happens all the time, but they're there to help get that edge in your favor. They're there to help you create some rules for yourself so that you can avoid taking trades on stocks that are clearly weak, or where the moving averages are clearly not moving in your favor, or where you can see that engulfing pattern, or you see that doji and you're like, well, shit, now I should start looking at when to exit or when to enter. So that's really the point of technical analysis. I know this class went really long, but I had a lot of stuff I was given to talk about, and it's this is important stuff. You can't gloss over any of this, because if you miss something like this and if you aren't prepared, you could get lit up. So I hope that this was helpful and informative. I really appreciate if anyone sat through this whole thing, especially if this was rehashing. Look, like I say in the beginning, our habit this week is being relentless, and this is part of being relentless in trading. I know all of this. I didn't have to sit here and put all this together, but this helps reiterate some shit in my brain. It's nice habit building, and it's a nice reminder. So I will see you all tomorrow at 7 p.m. for a shorter technical analysis trade where we're going to talk about indicators. We're going to talk about RSI, stochastics, MACD, Bollinger Bands, all these other weird things. And we're going to give you a little more insight into technical analysis. And yeah, so I hope that this was helpful and informative. We will see you next time. If you liked this, if you're watching this later, if this really informed you or you're curious to know more, drop a like, leave a comment on the video, or just simply subscribe and hit that follow button and turn on notifications. I will see you all next time. And as always, safe trading.